It's time for the property doomsayers to admit they're wrong. And that's one of the topics we discuss in today's Property Insider video chat with Dr. Andrew Wilson, as well as what's happening around our property markets, including the latest auction results, listing data and sales data. So if you want to keep up to date with all that's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so you can keep up to date every time a new show comes out. It's time for those who predicted a property crash and a long, painful climb out of a recession, or the fiscal cliff last September, or another cliff that we were going to fall off in March, when JobKeeper ended. It's time for them to admit they were wrong. Property markets around Australia have hit a new high, and we're in line for strong double-digit growth this year. The Australian Bureau of Statistics has confirmed that Australia's employment recovery is stunning, and at the end of JobKeeper, it's likely that we're just going to have a little speed bump rather than a cliff to fall off. Employment is now 69,000 people higher than before the pandemic began. Hours worked are up by 1.2%. Workforce participation is at a record high of 66.3%. And Deloitte Access Economics says that our GDP, our economy, has returned to its pre-pandemic levels. Probably that happened sometime in February or March. We'll soon find out from the latest statistics too. Yet there's the usual band of property pessimists still out there, telling anyone who's prepared to listen that a property crash is inevitable. And it's not just Harry Dent who's comfortably sitting overseas telling us that Hong Kong and Australia have got the most overvalued property markets in the world, and it's going to be a bloodbath for property globally. But locally there are still the regular property pessimists who believe property prices are going to plummet over the next couple of years. I know one recently received quite a bit of publicity when he suggested that nationally house prices are going to readjust somewhere between 20 and 45% because of massive unemployment, because JobKeeper payment reductions, because of mortgage stress. And interestingly, that's the same person who's kept saying that for years, just kicking the can down the road, saying this property market's going to crash. So who should you listen to? Well, I know who I'm listening to, an economist who's been very accurate in his forecasts, and that's of course Dr. Andrew Wilson, Chief Economist of My Housing Market. And in this week's Property Insider Chat, you'll hear what's really happening in our property market, as well as Andrew's response to that almost daily diatribe being espoused by the naysayers in regard to the national housing markets and their predictions for a housing market crash. Hi, Andrew.
Yes, good morning, Michael. Very interesting introduction as usual. And did you mention the debt bomb? I'm not sure if you mentioned the debt bomb.
We left that one out.
Well, that was part of the narrative from those sections of the commentariat who love a good horror story. But story, I think, is the clear word there we need to be focusing on. It is a bit of a story. But yes, onwards and upwards this weekend, of course, and following on. And it's obviously a very interesting time in the market at the moment.
Well, I'd like your response to that almost daily diatribe that's being espoused by the naysayers in regard to the housing markets. But before you do, I'd actually like to put it in context by discussing what's actually happening in our property markets at present. So let's start, as we usually do, with the auction results. But Andrew, once again, the media, probably looking for something to say, they're sick of saying how good the housing markets are going. The media, once again, likes to remind us that auction clearance rates are a little bit lower than they were at the beginning of the year. But at any other time, these type of auction clearance results would have been considered boom time results, Andrew.
Well, we've sort of gone from what were clearly record results, Michael, through March and into April to near record results over the last 3 or 4 weekends. And there's clearly a reason for that, and that is distraction. Buyers and sellers are distracted because April, as usual, is a significant holiday period. And we see listing numbers, sales numbers, auction numbers falling as a result of those distractions. And this year hasn't been any different. Interestingly enough, the clearance rates have only fallen marginally in most of the capital city markets during this distraction period, despite falling numbers of participants in the marketplace. So we've now come to the end of the distraction period. We're all back at work for the first time in a month. Most of us are back at work, I'd suggest, for the first time in a month. So the data coming through over May will certainly give us a more reliable insight to, I guess, a normalised market environment. And then we can start speculating on whether we're going from white hot to red hot. But let's understand, Michael, we've always said that the market would ease at these levels of growth, which are near record levels of house price growth, wouldn't continue because affordability barriers would start to rise with higher prices. And there's nothing really to continue to drive higher prices at these levels, particularly lower interest rates or higher income. So it'll be a natural process of decline, easing as property becomes more expensive, and that restricts buyers from securing property at the rate that we've seen in this catch-up mode part of the cycle that we've experienced over the first quarter of this year. And we saw those auction clearance rates, Michael, down a little bit on the Anzac Day long weekend. Melbourne under 80% again. It's tracking at around about its lowest point of the year. But as you suggested, that's still a very strong result for sellers, that 8 out of 10 chance of selling your property under the hammer. But other markets, I mean, it's sort of ho-hum about Sydney that was 85, 86% clearance rate, which a month ago or 2 months ago would have been shouted from the heavens as absolutely astonishing. But of course, Sydney's tracked back from those 90% clearance rates. And the other smaller capitals really haven't looked like they've missed a beat. Generally, Michael, Canberra, another big result, same as Adelaide, and Brisbane continues to be a booming auction market. But yes, numbers were lower, holiday distractions. There were official Anzac Day long weekends in Adelaide, Canberra and Brisbane, Michael. Melbourne and Sydney didn't have official long weekend holidays, but there were a lot of unofficial holidays, let me tell you, taken in those two capitals. I think a lot of workplaces offered that public holiday to their employees. And we did see a big drop in listing numbers as a result in those capitals as well. But as I said, clearance rates were still quite spectacular and very, very much in favour of sellers. And we would have, obviously, with those clearance rate, expect to see a continuance of very strong prices growth. Obviously, the next few weekends, Michael, will tell the story. We would expect an easing anyway, and we are moving towards the midwinter market, which is always a distracted period for our auction markets and our housing markets generally. Easing is the word rather than falling.
Well, how is that reflecting into the number of properties being put on the market, new listings, and in turn, the number of properties being sold?
Well, look, the latest My Housing Market data, Michael, has shown us, and there has been some speculation because new listings have been falling over the past month, that this was a signal that sellers were becoming disengaged from the market. But once again, it's the same factors that have impacted the auction market. New listings have fallen over the past month, but we've certainly seen at a national level a revival over the last week of new listings coming through into the market. And new listings are still well ahead of where they were a year ago, which was still pre-pandemic, pre-COVID, and are tracking at a level, again, in revival mode that would suggest there's still plenty of appetite from sellers to engage in the marketplace. And why wouldn't there be with prices growth and strong competition for property continuing? And if we look at the individual performances, Michael, in terms of changes over the past week for new listings, seen a fall in most of the capitals, but a rise in Sydney. But again, these are weekly data numbers that are affected clearly by the holiday distractions still engaging the market. And the only change there, when we look at the relative position between each of the capital cities for new listings, is that Melbourne has fallen against Sydney, and they're tracking at around about the same rate of new listings coming into the marketplace. So Sydney sort of held its own last week in terms of new listings. Other markets fell away, likely again reflecting those holiday distractions that kept sellers waiting perhaps until next week to get back into the market. And look, total listings, that's affected that as well. We've seen total listings rise everywhere except Adelaide and Perth, which was reasonably flat. And I think those total listing numbers reflect what was, again, similar to those new listings data, that new sales were also down over the past week. And of course, particularly in Sydney and Brisbane, and that acted to keep total listing numbers higher. So in terms of the relative position, Melbourne certainly has a clear advantage in terms of the number of properties on the marketplace, well ahead of Sydney, and also in terms of the newly reported sales over the past week. Melbourne is also around about 6% more new sales reported last week compared to Sydney. So we have, a mixed bag of activity for new listings and new sales over the past week, Michael, but we need to take it all with a grain of salt because of the impact of holidays, which have now come to an end. So we'll see a more of a robust trend emerging to give us clearer insight into what's the underlying energy of the market is. But the overall trends are clear, that new listings continue to rise, sellers are still engaged, and the number of new sales this year so far is very strong in each of our capital city markets compared to the same period last year. Of course, those year-on-year comparisons are now becoming problematic because we were heading into the depths of the COVID shutdown last autumn at this time.
Yes, it's interesting to look back what's happened over the last 12 months. Andrew, earlier in the chat, I asked you about your thoughts about the regular commentary from the negative Nellies, those property pessimists who believe our property markets are heading for a significant crash. What would you say to them?
Well, look, it's a business, isn't it, Michael? And if it's attracting attention, I guess it's up to those that promote those views to, understand that over time, credibility is important, particularly, to the financial media. And they were burned last year because they did follow down that track of erroneous predictions that was basically across the board, and not just from the clickbaiters, but also from more of the, respected parts of the business community, particularly the big banks who clearly got it wrong as well last year. We can't, look to them as having the excuse of trying to seek attention because it is their business. And being their business, it's important they get it right, Michael. And I would say to anybody it's very exciting to read these doom and gloom types of headlines and storylines and analysis. But if you are making a business decision based on that, I would suggest be very wary of it. And those that did make business decisions a year ago, obviously based on what were horrendous predictions of house price crashes and economic crashes, would have unfortunately, given the reverse of all that this year, paid in terms of personal losses. If you're making a business decision based on those extreme predictions, particularly negative predictions, you need to be extremely wary, because if you had, just consider how prices growth has actually increased, not just this quarter, but if we look over the past 3 years or even the past decade, and the positives are still there going forward. And as you said at the beginning, Michael, we will get 10% plus prices growth in most of our capital city markets this year, I believe, even with an easing in prices growth, which is likely over the second part of the year particularly.
I think we've got to clarify that. Yes, I think we both agree there's going to be an easing in property price growth, which is not a falling in property values, but really it's unsustainable to grow at 0.5% every week in property values.
Well, we can do it if we're cutting interest rates, Michael. If we can borrow more, we can do it. Everything's sustainable if we're getting the drive from affordability, and that means lower interest rates or higher incomes. Well, that's just not going to happen. That's the argument about sustainability, is just a throwaway word from some, and they don't understand why it's not sustainable. And the reason is because we can't cut interest rates, and because our incomes are at the lowest level on record. And nothing's going to change there, Michael. We're not going to have high interest rates for a short term and then be able to cut them, because high interest rates would obviously mean lower prices anyway. And we're certainly not going to get a boom in incomes. So that means it's unsustainable with those key conditions. And that is why it will ease in a moderate way, rather than a sharp easing of prices or falling of prices, as typically happens in strong parts of the cycle when we have the Reserve Bank entering into higher interest rates to cool what is generally also a very strong economic environment. Completely the reverse at the moment. And that's why it's clearly not sustainable, Michael.
Sure. So the growth isn't sustainable, but the government and the Reserve Bank are very happy our housing markets are increasing in value.
Absolutely.
That brings on the wealth effect. It means we spend more, not just on our houses, but when we feel wealthy, we'll go to restaurants more, we'll buy cars. It greases the wheels of industry. No one who's got the golden rule, the people with the gold make the rules, and none of them actually want at the moment our housing markets to slow down too much.
Particularly state governments, Michael.
Yes, it's bringing in a lot of money into their coffers with the stamp duty. Look forward to chatting again with you next week, Andrew.
Yes, thank you very much, Michael.